Hello, this is Brian Rezny, President of Rezny Wealth Management, bringing you an important update about the economy and the investment markets. Well, the third quarter is over. We had volatility, of course, for the first 3 quarters of this year. And as I've talked on every one of our update videos that I do approximately every other week, volatility is normal and nobody likes it. But one of the things I want to really address is, when you have these kind of dire pullbacks and you're down 15% on your account and you're retired and maybe you're concerned because you're retired, remember, we get 10% pullbacks in all asset categories, not just the stock market. People think, wow, I've got money in the stock market. Is that risky? All assets are risky, whether it's the bond market, whether it's real estate, gold, the stock market. Remember, you're not going to spend all of your money in the next 3 years. You're going to spend pieces of it. So as long as you're a 3-year investor or more, you're a long-term investor. Nobody likes volatility. I realize, hey, you had $1.5 million in your portfolio. Now it's $1.1 million. And you're thinking, wow, I'm down $400,000. That sounds like a lot of money. But look at how you did the 5 years before that. And most people never realize or really put those numbers together, which we do. In fact, I looked at this for a particular client just the other day. He was concerned that he was down $400,000. And I said, but do you know what your net return is after that drawdown? Meaning you had $1.5 million, it's down to $1.1 million, but what was your return up to this point, even with the drawdown? Let's say it was 9% net return annualized the last 5 or 6 years. That's pretty incredible. That's after this pullback. So if you weren't invested properly the 6 years before, you wouldn't have the money to draw down, and you still have more money than you would have had. Now, that's not a guarantee to the future, but I like to put things in perspective. But let's talk more about future volatility. It's going to be normal. We're going to have it. The next 3 years, I see greener pastures. When we look at the inflation front, and this is one of the things I've talked about a number of times, and I talked a lot about this the first half of this year, which is as we get into the second half of this year, we're going to start seeing this rollover of some of these inflation numbers. And again, a lot of these leading numbers 3 months ago were already starting to roll over. So remember, what you're looking at is inflation, year-over-year inflation numbers. We had a lot of inflation in the last 12 months. The numbers that are now coming in are not as high, so that means next year inflation will not be 8 or 9%. Realistically, we could be running 2 or 3% inflation as we get into next year. Again, year-over-year numbers. And the thing that you need to understand when you're looking at inflation is it's that year-over-year increase. So because the economy was already starting to slow, a lot of the leading indicators that go into the inflation numbers were already rolling over. As we get into, again, this quarter, and as we get into the next quarter, we firmly believe we're going to be in that 2 to 3% range on inflation for next year, 2023. There's even a potential, if the Fed keeps raising rates too much, which could happen, we could have some deflation. Again, I'm hoping we don't have that. But generally speaking, moderate inflation is where the Fed wants to go. I firmly believe as we get to the end of this year, they're going to slow down on their interest rate increases, and they probably at some point will start reversing course next year. What does that mean for the economy? It means that we have a chance for another bull cycle for an extended period of time. We go up 5, 6 steps, we come down a step or two. That is investing. Whether you're conservative, whether you're growth or you're something in the middle. You're never going up 5 steps and another 5 steps. You're going to go up 5 or 6 steps and come down a few. If you're more conservative, you're still going to have volatility, maybe not as much. But what's interesting is when I look at this year and I look at how a lot of the big Wall Street firms allocate all the time, and they do these 60-40 portfolios of equity versus bonds, the bond market, especially long-term treasuries, has done substantially worse on the decline and had more volatility bonds than the equity market year to date. So bonds are not necessarily a safe investment, and if you were a 60-40 portfolio allocated how a lot of the brokerage firms have their clients, you'd actually probably be down even more year to date. So what we're looking at is this. We're looking at inflation starting to get a little bit more subdued as we get into next year. We're looking for the Fed to stop raising rates as we get into next year. And we're looking for a potential reversal. When things are the most dire is the time you want to be invested or maybe increase risk a little bit. We're looking at a few allocation changes in our portfolio because where interest rates currently are, where we see them headed into next year, and we still see the U.S. economy as the strongest place to be invested. Volatility is normal. It's always been normal. It's going to continue. Let's go 5 or 6 steps. You're going to come down a step or two. Your portfolio was $1.5 million. It's now $1.4 million. But again, it only would be $800,000 if you didn't invest properly the 6 years before that. So put that into perspective when you're looking at the increase or the decrease in the value on the short term of your portfolio. Investing is a long-term animal. Whether you're 85, you're 25, you're a long-term investor. As long as your money, you're not going to spend all of your money in the next 3 years or less, which of course is none of our clients. You need income, you need growth, you need to combat inflation, and you need to stay the course. As always, if you have any concerns about your portfolio, please give us a call and we'll answer any of your questions or schedule a phone or in-office review. We want to make sure that you are comfortable and that you know we are on the job. And one other side note, we've heard from a lot of clients because of the hurricane. Again, we wish everybody the best. I know some of you have had damage and you have concerns or things maybe what you should do about the house or things of that nature. Again, you can call the office to discuss with us. We have a lot of knowledge, not only obviously on the money management side, but also things often about maybe a little disaster relief or things maybe you should be doing when it comes to claims or who to talk to in general with some of your problems that occurred from the hurricane. We wish everybody safety from the hurricane, and of course, hopefully we rebuild quickly and we get back on track and put this all behind us. Have a safe and profitable day.